Folks, we got to talk about the financial markets. This week was particularly interesting. Not only did you see several individual companies do very poorly, such as the aforementioned Gap stock, but also the major indices, while they went up a little bit on Friday, they also posted a weekly loss. And technically, we are looking at a situation where the broad indices are running out of energy. They're running out of good news that could keep Wall Street interested in pouring in more money. There is pensiveness going on. There is a sort of risk calculation. And I think this risk calculation that's occurring right now at this juncture is very critical because next week, starting from the middle of next week on Wednesday, we have JP Morgan, which is of course, the biggest bank in the United States. They're going to release their earnings report, followed by the other three banks that make up the big four, Bank of America, Citigroup, and Wells Fargo. And I don't think that any one of those banks have really great news to offer, because back when the markets were suffering through the Great Recession, there was that debate about how certain companies and certain banks are too big to fail. But moving forward in 2016 and beyond, I think the question really becomes too big to succeed. I think that JP Morgan is really keying in on this. I think its CEO, Jamie Dimon, is personally worried about it because he's got a lot of assets, yes, but he's also by nature leveraged towards multiple international markets, multiple international indices. And when you look at those international markets, for example, looking at the Shanghai Stock Exchange, yeah, it's been moving up since the beginning of March, but it also started to tick down a little bit over the past 3 days, and there's again pensiveness. Really, year to date, the Chinese markets are still negative, and there's still some questions about where to move forward. The monetary stimulus program really hasn't worked. Then you look at neighbor Japan. I think the Nikkei 225 index is in real danger technically of forming a broadening wedge pattern, which implies future volatility, but it also implies a bearish trajectory. I don't like how small the trades are moving after a pretty steep drop. It seems to me technically that the overriding dominant trajectory is bearish, and without some real positive fundamentals, I think that there is great risk of the Japanese markets continuing to slide. Then, of course, you look over into Europe, which is led by Germany, and the German DAX composite index, again, it has that pensive feeling, that pensive sentiment. We're looking right now technically that the markets are really not moving anywhere after suffering a pretty steep drop in early April. And where we are now, the price action for the German DAX is right where its 50-day moving average is. And the 50-day moving average is below that of the 200-day moving average, which suggests that the nearer term momentum is weak and the overall trajectory of the longer term price action is also weak. And again, without some positive fundamentals, either in the domestic economy or in the international markets, without those positive fundamentals, without something to look forward to, I say that there is going to be a continuation of the overriding trend. The overriding trend here appears to very much be bearish. So we've got some major problems, and I think those problems really start to reflect itself in the U.S. markets. Again, when we look at those earnings reports from JP Morgan and the rest of the big banks, even if they were positive, let's say they meet the earnings expectations, but really it depends upon how much they beat those earnings consensus targets. If they don't beat it with enough momentum, with enough energy, with enough magnitude, I say that Wall Street investors will look at that and see the unconvincing nature of the earnings report performance, and then see the unconvincing nature of the international markets as a whole, and they will drop out of the stocks, out of, in particular the big banks, but also stocks in general. I think this is a very critical juncture, like I mentioned earlier, and we just don't find from where we can get the good news. Even the Federal Reserve, even Janet Yellen personally has admitted that she is concerned about the lack of wage growth. Yeah, we're seeing nominally the labor market improve thanks to Walmart and Target jobs, but we're not seeing wage growth nationally, broadly improve. That's a major concern. And when you couple that with some worries regarding the earnings performances of S&P 500 companies in this second quarter season, I don't know. I mean, this is a very dangerous and I think a very risky situation. All I can say at this point is just be very vigilant with your investments. Be very vigilant with your portfolio, because we could start seeing some nasty volatility moving forward.